Last week, we analyzed three assets, SPY, Gold, and Micron. And all three moved exactly the way we laid out. Was that luck? Was that predicting the future? No. This is what happens when you do the work before the trading week starts. When you combine technical levels with option positioning, open interest, and dealer exposure. The market loses most of its ability to surprise you. This isn't about guessing direction. It's about understanding where liquidity sits, where traders are positioned, and where pressure builds. So when price moves, it's not random, it's forced. In this video, we're doing the same thing again, but step by step. First, we'll quickly review the three steps from last week and break down how and why they played out. Then in the second part, we're setting up a fresh analysis for the new trading week. A new SPY breakdown plus three additional stocks, all through the same lens: market structure, options flow, and positioning. Watch this one until the end. If you trade, especially options, this is information you don't want to miss. Now, the first asset we talked about last week was SPY. We talked about how there was a heavy concentration of puts going into the Friday, January 30th expiration. When the market gets overloaded with downside prediction like that, it often struggles to sell off aggressively. And that's exactly what we saw. The market tried to push lower, but over the last two sessions, downside momentum stalled. Too many puts can act like a cushion. Dealer's edge, liquidity shift, and the drop loses speed. The second analysis was gold. We highlighted the massive call build-up at the 456 strike, and I explained the scenario where option riders would have no incentive to let those calls expire in the money. That scenario played out, honestly, in a pretty impressive way. Over just 2 days, gold dropped roughly 13 to 15%, forcing the GLD ETF, that's the most heavily traded gold tracker, to push that overloaded 456 strike out of the money by expiration. Classic positioning unwind. Classic Max Payne behavior. The third stock we talked about, and one we'll keep discussing in this video, is Micron. MU had a phenomenal run, even extended a bit more this week. But you can clearly see momentum stalling into Friday's session. Alright, let's start, like we usually do, with SPY, the ETF tracking the S&P 500, heading into the upcoming week. When we look at the options data for this Friday's expiration, February 6, we can see that there are still a lot of puts in the system, just not as extreme as what we saw going into last week's expiration. Right now, the main put walls are stacked around 680, 675, and 670. And this part is important. A clean break below 680 would open the door to a much more bearish environment, with a real possibility of a fast move lower, potentially pushing SPY straight through the last major put wall at 670. Because of that positioning, the bias I'm leaning toward for this week is to the downside. Now, if we zoom out and look at the S&P 500 chart and run a quick Fibonacci retracement from the April of 2025 lows up to the recent highs, we can clearly see the first key support level around 647, and this level line up well with the option structure and some other indicators I'm using. And that gives us additional context for where the market could realistically be pulled next if selling pressure accelerates. The next name we analyzed last week, and one I'm still watching closely, is Micron. Looking at Micron's near-term option expiration, there's a large and very noticeable put wall at 370. That's a level I think is absolutely worth tracking. If we continue to see weakness in the stock, and especially if price breaks below 400, that 370 level could come into play much faster than people expect. That said, and this is critical, Don't be the first mouse into the trap. The second mouse get the cheese. Be patient. Let price develop. Let the stock show its hand on Monday as the new trading week opens. That way, you're making smarter decisions heading into Friday's expiration instead of reacting emotionally. The third stock I'm watching going into this week is SNDK, SanDisk. SanDisk has had an absolutely phenomenal run over the past few weeks. Since September of 2025, the stock is up nearly 1400%. But last Friday it printed a very aggressive bearish candle with heavy selling volume, something you can't ignore. When I pulled up the options data, especially looking at the monthly expiration, here's what stands out. With the stock currently trading around 576, we can see that the 600 core wall was aggressively broken on Friday. Price even pushed close to 680 before getting sharply rejected and dropping back down. On the downside, the next major put walls are sitting at 540 and 500. Given how fast this stock moves, a break below 560 area could easily trigger a move into the first put wall at 540, and if that level breaks with momentum, the stock could very quickly find itself testing the next major put wall at 500. This is exactly why options positioning, liquidity, and price structure matter. The market doesn't move randomly. It moves toward pressure. Now, before we wrap this up, I want to leave you with two practical options trading tips. Tip number one, try to avoid trading options on Monday, right at the open of the trading week. Monday is usually the day when positionings are still forming. Flows are just starting to show, dealers are adjusting hedges, and real conviction hasn't fully appeared yet. Because of that, in most cases, not always, but most, price action tends to be mixed, choppy, and directionless, which is not an ideal environment for option buyers. Tip number two, in a market like this, where we go up one day, down the next, and price is mostly range-bound, a high-quality options trade is one where the option expands on the same day you enter. If you're already sitting on unrealized profit on day one, you give yourself flexibility, whether that's taking profits, scaling out, or holding the position into the next session with a cushion that actually justifies the risk. And just a reminder, something we've talked about in previous videos, the upcoming earnings week is just as packed as last week. Personally, I'm not a fan of trading options right before earnings. Option premiums are usually expensive, implied volatility is elevated, and most of the expected move is already priced into the options. That's it for this one. Another episode of E.L.I Trading Strategies. I'm Roy, and as always, wishing you all a green and disciplined trading week.